All right, we will go ahead and get started. Good afternoon, everyone, and welcome to our timely webinar, The Middle East Crisis and What It Means for Global Energy Markets. My name is Mark Marifian. I'm Tortoise's head of product, and we've been doing these webinars pretty regularly, weekly, since the conflict broke out. We've also been, covering this on our website with some written pieces. Really started first talking about this January and how we were thinking about the risk at that time. As we dive in, just a quick housekeeping note: we will leave time at the end for Q&A, so do feel free to submit questions at any point. We'll try to address those with the time remaining. For those new to Tortoise, welcome. We're energy specialists. We've been investing for over 2 decades. Today we manage 11 billion in assets, really across the value chain from the wellhead to the end user. Today we've put together some slides. We'll quickly frame what's happening and provide some background. What you're seeing really is a market that is changing, I'd say day by day, and in some cases really hour by hour, tweet by tweet. Just taking a step back, energy clearly had a strong first quarter. The sector was up 40% at one point. We've now had crude prices elevated for approximately 45 days, and so that really is a key issue to watch here. As prices stay high, that can create pressure on consumers, economic growth, and really impact broader financial conditions. So, it's also increasingly clear that I'd say the commodity flows, the physical flows, they're not going to look the same after the war as they did before the war. So the real questions that we're asking is how long is the conflict going to last? How severe will it become? Could this contribute to potentially a more serious economic pullback? So if we go to this page, why the Strait of Hormuz matters. Obviously we all know the Strait of Hormuz is a major choke point for commodity flows. 20% of the world's crude, 25% of the world's LNG goes through this corridor. And what you see on the right-hand side here is just the number of barrels per day coming out of the strait, which you can see the vessel count is way down. You're at about 10% of pre-levels. That's about 2 million barrels a day in the blue line. It's up a little bit recently, but then dipped back here over the last few days. Now, what we're not showing in the chart or in the picture is the Red Sea. The Yemen's Houthi rebels, they formally entered the conflict a few weeks ago. And so their key leverage would be to threaten Saudi Arabia's export hub. That's where the East-West pipeline ends. And they could disrupt traffic at the southern entrance of the Red Sea. So that could also weaken Saudi Arabia's ability to bypass the Strait of Hormuz. So if we go to the next page, okay, this is really the breakout, the kind of a key page. We can spend just a minute or two here. Here's what happened before. You had 20 million barrels a day, and you can see how we've cascaded down. So I'll just quickly walk through these. On average, you're getting about 2 million out from Iran. That we talked about that number being down 90%. You've had some pipeline rerouting. I would just note that the lengths that some of the countries are going to get crude out is pretty wild. Iraq is actually transporting 250,000 barrels a day by old pipelines that were formerly shut down. They're also trucking through Syria and Jordan. So anyways, this is not something that they were prepared for. You also have had G7 SPR releases there, for 1.6. And that was the largest SPR release ever in total of 400 million. And then we're starting to see, crude on water has also, softened this a little bit. But that net is not going to be that impactful. So overall, you're looking at an export deficit of about 13 million barrels a day. Then you got 3 million barrels, or about 120 million barrels in total that are sitting on water or in storage tanks in the Gulf right now that can't get out through the Hormuz. So This is quite an issue. This could get worse. And how could it get worse? Iran actually, what I've read is that they're potentially 10 to 14 days out from having to force or shut in their production. So, they're getting out a couple million barrels per day, but potentially you could see that production shut in as well. And again, shut-ins are really important here because they're harder to reverse than export disruptions. Once you run out of the storage, reservoirs get damaged, and then the time to bring back the physical flow becomes much longer. So if we go to the next page, the big question, why hasn't the supply shock been felt like this, been felt yet? We actually zoomed, that's Goldman's chart, we zoomed all the way back to 2018, but you can see how quickly inventories rose during COVID and the dramatic price change you had there. Now, we haven't had that severe of a we're going the other way with the drawdown, but you're not missing it by much. So right now, what's happened, we actually built a nice cushion in 2025. Inventories, you can see, increased about 500 million barrels a day to over 8 billion. But this is evaporating. You're already down about 300 million in March. You're probably going to be down another 300 million or so in April if we continue. And so really you're just watching is when do inventory levels start going down well below historical norms? That's probably what's going to push prices up. I would also say not all barrels are created equal. So a significant portion sitting in China, that's not coming out of China. A lot of these a lot of these barrels are held for their domestic consumption. You also have a mismatch of fuel where different fuel grades are needed by different refineries. So logistically, this really starts to become a mess when ships might be on the wrong side of the world, fuel grades aren't matching with the refinery, etc. So again, we're this buffer that we've had here in the blue line, it's starting to be drawn down. If we go to the next page, okay, so where are you starting to see the supply disruption? No shock here, but it's really in Asia. Asia's closest to the Gulf, so that's where you're seeing the disruption. Persian Gulf's a major exporter of diesel, gas, petchem. You can see it all here on the left. Asia's there in the green, so really makes sense that Southeast Asia is kind of the first one being hit. And then you're also starting to see concerns, I'd say, in Europe, where about product shortages there. The EU is actually telling its citizens to conserve energy. So, that's something that maybe not as much in the headlines today. It's more acutely being felt in Asia, but potentially could roll to the EU next. And you can see that on the right-hand chart there, just the absolute spike in prices for Asia in the red. The EU in the blue is a little bit less, and then the US has been the least impacted. If we go to the next chart, okay, this is what we've been showing kind of week after week. And we did a piece in January, said if there's a disruption, what could happen? And I would say we are past point scenarios 1 and 2 right now. Longer term, we're probably closer to scenario 3 and pushing our way to scenario 4. Certainly in the short term, you were closer to scenario 4. So I'd say before the crisis, we were kind of anchored in that $60 to $70 range for crude. Today, the question we're asking is that $75 long-term target appropriate? Or would we be higher? Again, you're talking about estimates of 10 plus million barrels a day of supply that's lost. OPEC's supply went from 33 million the month previous to 25 million in March. You also have NGLs and condensate volumes, about 2 million barrels that aren't getting to market. And then you have refining capacity, which is offline in the Gulf as well for about 3 million barrels. So this is just really an extraordinary disruption of the supply chain on the commodity side. And so, that's hence why we're sitting there between scenario 3 and scenario 4. Now, the one good thing I would just say is that over the past, 2.5 weeks, the escalation around energy infrastructure has calmed down a bit in terms of the damage. But In total, we've seen about 50 to 60 energy infrastructure facilities damaged. And the most severe one was the Ras Laffan in Qatar. That's the largest LNG export facility in the world. So about 20% of that LNG was damaged, and it's not actually going to be coming back online for 3 to 5 years. And the reason for that long repair time, there's just so many pieces that go into building an LNG export facility. The one backup here is that GE Vernova and those gas turbines that are built, you're seeing a delay of 5 to 7 years to get those to market. And so, that is one of the reasons why you're seeing an elongated timeline to market for the LNG repairs there. I'd say the EU also should be you're a bit cautious there. That their gas storage was pretty low going into this, so I think there's a concern about supply and what do those industrial users do, and what's their ability to restock there as we get into the summer. In terms of refining and LNG, U.S. export markets on the LNG side have been very, very stable. We're seeing wider spreads. So that's benefited U.S. exporters from that tightening global supply on the gas side. And the LNG stocks have largely priced that. They're up about 30% plus year to date. And then we mentioned the 3 million barrels of refined product exports that are not coming to market in the Persian Gulf. You've seen the diesel cracks expand quite a bit from the Gulf Coast. And so that's certainly benefiting the refiners. If we go to the next page, okay, this is just the front month versus the back end and the repricing of the curve. So this is now going on for a month, so you're not seeing too much change in the curve month over month, but you have seen that purple line, which is a 1 month ago versus today. The green line, it's starting to increase in the back end, and I think that's something important to watch, because that all of a sudden is now signaling, hey, this is a longer period of time where you're going to see elevated prices. So we are trying to do things from the U.S. side to minimize the overall increase in prices. We've increased tankers reinsurance program. We did an SPR release. We've eased sanctions. Right now we have a ceasefire, but I would say this most recent action, which is the blockade of other ships passing through the Gulf by the U.S., that's actually a de-escalation. That's not a de-escalation narrative. That runs counter to that. It's actually an escalating point. But we'll see how that plays out. I'd also note that President Trump said over last week that we can expect prices are going to be higher likely through November. So that was the first time I had seen, at least, that he's acknowledging that you could see prices higher for longer. So take that at face value, but that was a notable shift from what I had heard in the press. And when you total this all up, we are just burning through the shock absorbers. So again, the system can only take so much, and we really need to get these barrels back online, or else you're going to start seeing demand destruction. If we go to the next page. Okay, now we're going to just pivot the last couple slides to the U.S. This chart has the rig count as well as how for gas and oil, and how they've trended more recently, and you can just see the rig count has continued to decline, and this is different than past cycles. I'd say despite the higher prices, we haven't seen too much change in activity. I do think you're going to start seeing some activity, but overall, the energy sector, you've had a structural shift over the last 10 years where you're much tighter from a capital discipline standpoint, particularly after COVID. We've drilled through a lot of our higher quality locations, our tier one locations, and And then we also have less drilled but uncompleted wells. So, what you've seen, yes, the rig count's been down. U.S. production the past, 3 years, 2.5 years, essentially been flat. So what you're seeing is everyone talking about a more mature phase. I agree. We are more mature than we have been in terms of production and how much we're going to bring to market. And I'd say the million barrel uh, a year growth is behind us, but we still do have capacity to ramp here. I think the U.S. Shale is going to be an ongoing winner, even your tier two and tier three shales, because we have had improved recovery rates. We're applying new technology. We're applying AI, to these existing rocks and in geologies, and that should help get production out of the ground. And we did get a note from Continental Resources, which was public. They went private, Harold Ham shop. They expect that they are going to increase production moving forward. They're in the Bakken, more tier two. So I thought that was notable. First kind of signs that U.S. production could be increasing. But again, you're probably not going to see that million barrel plus a year increase like we saw from 2017 to 2020. And then the last page here. Okay, and then this is just exports, but the U.S. really has a critical supply and unstable supply of production for the world. Wheat prices would be significantly higher without the growth we've seen over the past 2 decades. We are starting to see exports, reflect that increase in the war. So it's not shown on this page, but I would note that exports look like they've gone from about 4 million barrels per day to 5 million barrels a day on the crude side. So again, you're starting to see more production get to market as the world is demanding our inventories. But as our inventories get down, the prices are going to potentially move higher here. So again, continue to watch that. LNG really looks like a clear winner. U.S. is supplying 60% of Europe's gas needs now. Pretty wild how fast that has happened as they've moved away from Russian gas. And so I expect you're going to continue to see those projects move forward. And then, for pipes and the pipeline gas, this is really the lowest cost of natural gas supply. So I think the pipelines and getting that gas to the market is going to be a long-term winner as well. We invest really across the energy value chain. When you look at our all energy strategy, we're going to be integrated across majors, midstream, upstream, refining. So, yes, we'll participate in the higher prices, but we're not going to be moving up to the same degree as maybe a short cycle E&P beta company would alone. So again, we're going to be more balanced in our approach and really own across the full energy value chain. Finally, I would just say from a portfolio perspective, the role of energy it's just another chance to highlight how important it's become. Today, we're at about 4%. Energy is about 4% of the S&P 500. Despite how it's growing in global importance to the economy. And we've seen this number be much higher in past regimes. 15% in 2008. It was up to 30% in the 1970s. So I'd say the one thing I mentioned it earlier quickly, but structurally, this group is much better set up from a profitability standpoint to invest in. They're thinking about their ROIC on growth projects. They're thinking about it in a much more mature way than they did it from the wildcatter shale days in the early 2000 and late 2000s and the early 2010s. So with energy, one allocation, you're going to get inflation sensitivity, you're going to get income generation, and then with the infrastructure and the midstream assets, you get certainly that hedge to geopolitical risk. So final takeaways, we'll continue to keep everyone up to date and up to speed on what is happening in terms of the supply disruption. I would say this is beyond just a geopolitical event. It's going to start impacting us in ways that we may not have expected going into this year. 2:20, we were scheduled for 20 minutes. We'll just give We got several questions. Yeah, one question after the dust settles, where does this leave North American energy infrastructure? I mean, it's pretty obvious. We're going to be more important than we were, and obviously we're the largest energy player in the globe right now. But I think you're going to continue to see importance, increase, and not only is Europe going to be reliant on us, but potentially others throughout the globe. Uh, Yeah, we answered how much additional gas, oil and gas upstream names can produce, how much volume can we process. So, upstream, I would say what you're seeing is a couple 100,000 or barrels per day of oil is expected to come online as we move through the back of this year, potentially more. We'll see where prices go. On the gas side, you are signing up, a couple new FIDs, but of course those take 3 to 4 years to be built and then get to market. So I think structurally, you're just building a longer term runway for gas and LNG specifically. And then how much more volume can be built on the midstream and the downstream side. Midstream, easier time in Texas, certainly to get the gas to market. The regulatory regime has softened a bit from where we were in the Biden days, but I'd still say Texas is the one you can count on. Harder in the Northeast, of course, that's where a lot of the low cost natural gas is in the Marcellus. And then on a downstream, that's going to be the refiners. We haven't built a new refinery here in 30 years. Now, we do have very complex and world-class refineries, but again, you just haven't built new ones. So again, those will take a long, long time to build. I believe President Trump said that they are looking to build a refinery in partnership with India. But again, this is not going to come online anytime soon. You're going to need a couple years at least to invest and get the infrastructure built. And then, I think the last question, how does this compare to 73 and 79 for oil? It's interesting. Energy is always changing. And we were really reliant on crude oil in terms of power generation in the 70s. Crude oil or fuel oil was 20% of the electricity generation today, in the 1970s. Today it's at 1%. So I think what this is going to do is create an opportunity really for all energies. Where can you be less reliant on this global supply chain that we feel is not secure as maybe we thought it was. And so does that open the door for gas? I think certainly is going to have its moment here, and it's reliable. Potentially you could see energy transition in terms of battery storage could also be pick up interest here. Renewables potentially pick up interest. But I think the biggest winner here is going to be natural gas, and then secondarily the ability to export this stuff and get it global to where it needs to be. So that's probably the biggest change from the 70s, is where you weren't necessarily producing it and exporting it. We are now just exporting it really all around the world. So appreciate everyone joining today. We'll continue to keep everyone up to speed, and we'll talk to you next week. Thank you.